Welcome back to the Wolf of Property and Casualty. I'm your host, Derek Laczniak, with over 15 years of commercial broking experience, focused on the middle market, upper middle market, national account space. The Wolf of P&C is a practitioner-led podcast designed for brokers, buyers, and insurance carriers. No bullshit, nothing to sell, each and every episode, each and every time. I like to find for this show sometimes not obscure, but often overlooked or glanced over coverages and talk about them a little bit more in depth, because you never know when you're going to have a claim for one of these coverages. You never know, brokers out there, when you're going to get called out in a meeting and a buyer's going to ask you about a coverage that you've gleamed over for the last 5 years. And I think if you're going to be a true practitioner, a true technician, or if you're going to be a true steward of your insurance program for you buyers out there, you should have a general understanding of what these coverages are, especially ones that are going to show up and that you need to have in each and every insurance program. Today's episode is about employee benefits liability cover. Employee benefits liability coverage, I used to call it HR screw-up insurance. That was my way of explaining to my customer what the hell it was, because when you pull back too many layers of this onion, you spend too much time talking about it and you can overcomplicate it. But employee benefits liability cover, I used to say, is HR screw-up insurance. It's cover for the errors and omissions or the negligence associated with administering traditional HR programs. Health insurance, life insurance, COBRA, enrollment and profit sharing. Large employers or complex employers or employers who have a lot going on, the HR team has got a ton going on. They're managing an HRIS system. They're managing open enrollment. They're managing dental benefits. I remembered at my old employer, we utilized an HRIS platform, and even using the best technology, but I had to go in and I had to do all the clicks. Then I had a kid, and then I needed to enroll the kid, and I had forgotten to enroll the kid in dental. So my kid went a year without dental at a time when he actually needed dental insurance. There's a lot of decisions to be made, especially if you have complex health plans, disability, life insurance. That's not to say anything of onboarding new employees or terminating employees that you let go. There's a lot of rules, both regulatory and in just managing all of the plans that come along with it. So obviously you need insurance for the HR professionals that are doing that. They're not perfect. They can make mistakes too. Employee benefits liability cover does just that. It is not to be confused with employment practices relations liability cover, which covers things like discrimination, wrongful termination, EEOC type claims. That's typically going to be bolted onto your management liability, tucked in next to your directors and officers and your fiduciary liability cover. Employee benefits liability cover is going to be bolted on 99% to your general liability policy. I've got an example of a deck page. It's going to be an endorsement more often than not up on the screen here. Limits are going to be typical. It's going to be also increased by your umbrella. So if you look at your policy buyers and you say, I have 1 million, why don't I have 3? Whatever you're buying your product liability, your general liability, your premise liability up to, this as a part, an endorsement to your GL goes along for the ride. So you buy it in a standard increment of $1 million. It is not unusual to have a retention, even if you don't have a deductible or a retention on your general or products liability to which this is affixed to. You're typically going to have a retention for whatever reason. It's customary on your employee benefits liability. This one that I pulled out is a little high at $10,000, but I've often seen $500. Sometimes it's waived. Premium, it's going to be included unless you're in a high hazard industry running a PEO or you have thousands of employees. Carriers don't charge for this. And that should give you a notion that there's not a lot of claims. In my career, I had one claim for this. And I knew many brokers who had double the time in the industry that I did that had no claims. Going down, when you see that retroactive date, that is interesting. And if you're a nerd like me and you like to understand some of the kind of backwards things that go along with insurance, hear me out here. Product liability, general liability, to which this endorsement is usually affixed, more often than not, is going to be an occurrence-based policy. Unless you're in a high hazard or an E&S play, unless you're making meth in the basement, you're going to have an occurrence-based policy. An occurrence-based liability policy says that when the damage or bodily injury occurred is the policy that responds, not when the lawsuit is made. So if I make a widget today that causes bodily injury, but I don't sue the widget maker for 2 years, the policy that was enforced at the time the injury occurred responds. This is a claim is made endorsement tucked onto traditionally occurrence-based policies. It does the opposite. It says that the policy that's enforced when the demand is made or the lawsuit is filed, regardless of when the action or the negligence took place, responds. So it's interesting that insurance carriers are going to issue a policy where they have kind of two bookends that they're managing exposure for two different coverages. I never really knew why they did that, but a carrier that jumps onto your program right now, Joe's Manufacturing, is using that retroactive date to say, I'm not necessarily going to cover anything that comes up before that date. This is a mistake on this policy. If you have continuous general liability cover and you've been in business for 20 years, that retroactive date should go back to the first time you bought general liability or employee benefits liability cover. It shouldn't be limited to a couple of years back. Some of the more extreme examples that are out there can happen. You fail to enroll somebody in a health insurance plan, and then that person has a really, really large claim. Or you fail to enroll a dependent, or there's complex family structures and you fail to enroll somebody in disability and the disability plan, and that person has a catastrophic accident. The claim that I had in my career was related to termination. There was a reduction in force that was happening to an employer, meaning they did a layoff. And the HR team, in the haste of going through the layoff, the company was in turmoil. They failed to officially offer COBRA health insurance benefits to a whole swarm of people, like 15 or 20 people. And COBRA, of course, is the required continuation of the health insurance plan at the full terminated employee's cost, meaning they pay the full boat, but they're guaranteed to get that access to that plan for 18 months or something like that. They did this layoff and they failed to use the protocol to offering that plan. And you guessed it, a number of people had large health claims that took place during that mandatory COBRA. And there was a lawsuit filed. And it ended up settling for a class action for, I think, a little over $600,000. And that was a meaningful claim. And we filed it on this coverage. Couple things I want to point out about this coverage that is pretty traditional, no matter what policy it's on, that I think is worthwhile. Buried in the endorsement and buried in the language, more often than not, employee benefits liability coverage is going to have some exclusionary language around payroll. So if you screw up issuing payroll or you're late in issuing payroll, payroll is not going to be traditionally defined as an employee benefit plan or a program. So just paying your employees doesn't get protection. That's a business risk. You got to have money to pay your employees. You got to pay them on time. So you paid me 3 days late, and subsequently I lost out on buying a Powerball ticket that made me $7 billion. That's not covered. Payroll and payroll associated functions are not going to be covered. If you're using a payroll provider like ADP, make sure you're making sure that they have professional liability cover to cover the exposure that they screw up and you get named in a suit. So that's one thing to look out for. The next thing to look out for is the definitions. There's two definitions. You can see them on here. They're in parentheses. Administration. What does administration actually mean? What does it provide your HR team to screw up? Typically, it's going to be enacting coverage, disability, health. It's going to be handling the rewards and communication. It's going to be communicating it to the employees and the dependents of the employees and the family members. So take a look at that definition, one-time brokers, so you're at least familiar with it. The second piece is the employee benefits program. Again, these are generally really broad. At the end of it, it's going to include something and similar programs to cover anything. These aren't the gotcha. We're not trying to list out things that are not covered, but be aware of it. I've presented thousands of insurance proposals. I have breezed over this cover a ton. This is not brokers where you want to spend, or buyers, 15 minutes talking about it, unless you have a very unique exposure. It's important to know the details. If it's printed on your proposal or in the policy, there is, and I continue to think that there will be even more, an expectation that you have some working knowledge around it, whether or not you've had a claim scenario. So keep in mind these little things. Keep in mind a little interesting factoid that if your client says, what's employee benefits liability? When they're talking to the proposal, you can say, it's HR screw up insurance. It's if Joan in HR screws up in the administration of disability or fails to offer COBRA to a terminated employee. It's really weird. It's a claims made policy on an occurrence form, but the limits follow your product liability, your general liability, and they're increased by your umbrella. Typically, there's no premium charge for it. If there is, it's about $300. Moving on. Now you've taken something that was obscure that no one's really worried about, and you rattled off like a professional exactly what it is. These are the little things that can make you brokers sound really polished. And for you buyers, you never know when something could happen.